Hello, all you lovely people out there. How are you all doing? I'm Kate Hill and I'm here to give you, as always, the best, honest commentary about our property markets, along with fantastic hints and tips as we go. So check out all my other channel content and stay tuned. Did you know, everyone, that pretty much every capital city in the country now has the median house price with the number 5 in front of it? The lowest city median house prices are now Adelaide and Darwin, with the highest medians, unsurprisingly, in Sydney and Melbourne, according to CoreLogic. Even some regional areas have median house prices at or above this level, such as in parts of New South Wales and Victoria. Now, the thing is that these figures were for the month of May. So with strong property prices continuing, the growth of those prices continuing, it might not be too much longer before those median house prices in every capital city is more than $600,000. So what does this actually mean for property investors? Well, it means that the days of strategically purchasing a solid investment property for $400,000 or so are numbered. In fact, to be honest, I'd say that they've probably pretty much gone. History shows us that the path of property prices is up. So investors have always had to increase their budgets as what is deemed affordable becomes more expensive. And then we all have to adjust to that new normal, that new affordable. One of the potential problems when this happens is that buyers with a more conservative risk profile can struggle to make that adjustment to the new price benchmark. And for them, perhaps buying an investment property that was priced at about $400,000 seemed like a low-risk proposition. That is arguable, of course. A more affordable buy-in price meant lower mortgage repayments that were likely to be mostly offset by the rent that could be charged. Lower price points also required a smaller deposit and/or equity drawdown to finance that property. But it might also mean inferior area. And being led primarily by price point rather than location is massively problematic in the long term and, in my opinion, way more risky. These days, to be honest, I can really only think of maybe 1-2 locations that investors can still buy property for $400,000 and continue to sleep well at night because of these sharp increases in property prices in most places. And by good, I mean areas that have all those great investment area fundamentals that we look for. Now, you may be restricted in purchase price by what the banks will lend you, of course, and that is a whole other matter. But unfortunately, some people have remained stubbornly fixated on purchasing at lower price points, even when there are very, very slim pickings out there. They are so enamored by their affordable investment philosophy that they will simply look for areas where property prices are still at that level. It's the main driving force. And as you should understand by now, if you've been watching my channel, there are many reasons why a location can be a strategic property investment opportunity, with cheap property prices never being the only one. It's interesting, but it's not the only one. What's concerning me at the moment is that the fear of missing out is causing bad decisions to be made by investors whose heads just have not caught up with market reality. And the next minute they've purchased in an inferior location, often in a one-industry town, where the only reason it was chosen was because property prices there fitted into a narrow bandwidth of supposed affordability. More experienced investors, or those who choose to work with experts, recognize that to purchase a property with the best chance of capital growth in the future, they probably need to increase their budgets. Not only have they made peace with $500,000 being the new black of property investment, but they are not too concerned about financing it. And that's because they have experienced maybe a similar uplift in their own home or portfolio, which provides more equity to use for the higher deposit required. And also they know that the rent returns and long-term demand for the property is solid because it's a good area. Plus, if they don't have access to enough cash or equity, then they are prepared to wait just a little bit longer until they do, until they've saved enough for that required additional funds for the deposit. They understand that patience will always pay much better dividends than buying something just because it seems cheap in market conditions that are strongly rising and they have got FOMO kicking around in their heads. So, my lovely peeps, don't forget, subscribe to my channel, hit the notification bell. If you are enjoying the free content, hit the like button too. I really appreciate it, and I will see you again really soon. Bye.